If not, I'll send out one more message letting everybody know we're going to get going, and then we'll get right into it. Break even price. Yeah, that's an interesting question. Yeah, we'll start by talking about that real quick. Give me 1 second to send this link out one more time, and then we'll get going. Cool. Okay. So yeah, let's start it off by addressing Zoom users' question real quick. They're asking a question which was related to our last lecture where we talked about the real, just kind of fundamental basics of options with the break-even price. Um, Generally speaking, the break-even price is only relevant when you're actually either exercising the contract or holding it until expiration. And we could even talk about maybe a more specific example with some charts. So let me just pull that up really quick and full screen this. So let's say, for example, we're trading options on the S&P. And I'll just clean it up really quick. I'll write the scenario out for everybody. So let's remove all of our indicators because we might not know what's going on there. All right. Let's get this all set up. So let's say, for example, we're trading options on the S&P and we buy, let's just do something relevant. We buy 580 strike calls. Let me make this a little bit more clear. Boom. Cool. So let's say we buy 580 strike calls, and this is the strike price of those 580 calls. There's kind of two ways that break-even price could be defined. It depends on, I guess, how you think about it. So one of the ways that break-even price may be defined is, let's say, for example, oh wait, sharing is not turned on. I was sharing my screen. This host isn't allowing multiple presenters sharing for this meeting. Give me 1 sec. Let me, oh, I see. I think MMA joined on the same account and that made it. No, Zoom's not trying to get us to pay more this time around. All right, should be good now. Sorry about that. Can everybody see okay? Cool. All right, yeah, sorry about that, guys. I think that was just MMA joining on the other account and it makes it a little funky. All right, so kind of back to what I was saying here. We're addressing Zoom users' just kind of first question earlier in the class related to what break-even price is. And that's a concept that we talked about in the last lecture. So let's say, for example, we buy these 580 strike calls. There's kind of two ways to think about what the break-even price would be. Let's first say we pay a premium of 5.00 or $500 paid in premium. We'll talk a little bit more about the options Greeks, but basically, one way to think about the break-even price is what the value of the contract will be at expiration. So that is basically going to be the amount of intrinsic value that your contract will have by the time it expires. So let's say, for example, we pay $5 for this 580 strike call. We would need to be $5 in the money up at 585 approximately in order to be break even at expiration, right? Because we're going to be paying $5 for the contract. When we are at expiration, we know that all the extrinsic value is going to be gone, right? Because extrinsic value is our time till expiration and our implied volatility, which is 0 once we're at the expiration date. So if we pay $500 in premium, we need to be $5 in the money, which would give us $500 of intrinsic value. So that's kind of one way to think about the break-even point. The other way to think about the break-even point is, let's say, for example, again, same idea, except let's do the 590 strike calls. So let's activate this. Let's move this up to 590. Oops, didn't mean to zoom all the way out. Let's move this up to 590. Okay, so let's say now we purchase the 580 strike calls for whatever reason, right? And let's say, for example, we pay, again, $500 for those calls. The break-even price that's generally, at least that was reflected in that screenshot that we saw, should have been the break-even price related to exercising the contract. So you could imagine, right? If we remember, when we buy calls, that will give us the right to purchase shares at a given price point. And I guess even, let's actually go back to our 180 example. It might be a little bit more intuitive. Let me go back to 580, I mean. So again, right, when we purchase calls, that gives us the right to buy shares at a specific point. And it wouldn't make sense if, let's say, for example, we just decide to buy 580 strike calls. And we can look at what the price of these are right now, 580 strike calls, which are already in the money. So 580 strike calls, if we scroll down to them on the options chain, they're going for $6.71 for the 580 strike call, which means basically we have about $2 of intrinsic value. And I'll just write down kind of the notes. 6.71 is premium of 3-day till expiration 580 Cs, right? That's a premium. So we'd be paying $671 for those 580 calls. We're currently about $2 in the money. So 2 ITM, which equals about 200 of intrinsic val, which means basically we're paying $400 for the time value and the implied volatility. So if we were to just exercise that contract right after we buy it, we would be losing a decent chunk of money, right? Because we would only be getting $200 of that intrinsic value back when we exercise the call. Because remember, if you buy a call and then exercise it, you get the right to purchase 100 shares at that price. And if we exercised, again, do the math here, we pay $600 for the right to exercise this call. When we exercise the call, we get shares, 100 shares at $580 per share. The SPY is up $2 per share from that entry point, which would mean we would be up $200 on our share purchase, but down $671 from our option purchase, leaving us to a net loss of about $400. So that break-even price that you would typically see represented in like the Robinhood UI or maybe some other UIs is going to be the price that the S&P or any equity that you're trading would need to increase or decrease to in order for you to essentially be flat if you were to exercise your contracts. And any price movement above or below that would mean that if you were to exercise your contracts, you would actually be in a net profit from the overall trade. Does that make sense? That was definitely a long-winded explanation to kick the lecture off. But yeah, does that answer your question sufficiently for you? I don't even remember. I think it was Zoom user who was asking. Cool. Colin's got one more question. How do you get the volume bars and chart bars to look like that? Yours are just lines, red and green, and not clear to read like that. This is probably a longer conversation that I don't want to get too deep into today. I will say we have some lectures on setting up Thinkorswim. I think I did one just a couple months ago. So send me a DM and I can get you the link to that one. But generally speaking, the way that you can customize your charts on TOS is just by going to the style settings, and you can basically do whatever you want from this appearance tab. So this will get you pretty far to what you need. Yeah, you're welcome. All right. Let's break into the PowerPoint here. And Lewis, exercising the contract is holding until expiration. So no, the interesting thing is in other countries' markets, you can't exercise before expiration. But technically in the United States market, you can exercise your contracts at any point once you purchase it. So you don't need to wait all the way until expiration. You can exercise at any time. So the break even technically does matter if you're not holding until expiration, but the break even should really only matter if you are planning on exercising the contract. And John, being assigned, same thing. Remember that the market is a zero-sum game, right? So if you're going to exercise a call contract to purchase shares at a given price, somebody is going to be assigned as well in order to give you those shares. So technically, I could go buy a 580 call right now. I could well, not right now, but I could buy it, tomorrow morning at market open. I could exercise it, and whoever sold to open that call is going to need to give me the shares, and I'm going to need to take them. Now, that doesn't make sense. Like, you are 100% just going to lose money. Like, you're guaranteed to lose money immediately on that trade, you are immediately going to be in the red. But you could do it. You would definitely piss off the person that sold that call, but they'd make money and they could just buy those shares back and still be in profit. All right, those are really good questions, guys. Yeah, so I want to welcome you guys all to our second lecture in the course series. How many of you, just so I can better understand, how many of you guys made it to our last lecture just a week ago? First lecture in the beginner's course series. Awesome. Yeah, so got a decent amount of people that were there, a decent amount of people that maybe missed it. Awesome. Well, yeah, I want to thank you guys all again for coming back again to the next one. I know we have a little bit of a smaller crowd. I think we probably messed up the posting of the links this time around, but not the end of the world. Regardless, I think this lecture is going to be kind of a pretty nice continuation from our last discussion. And then after this lecture is where we're really going to get into the meat and potatoes, and hopefully things get a bit more, I'll say, engaging. I think fundamentally, these first two classes are really, really basic. So if you do get bored throughout them, I apologize. It's really kind of starting you guys all off from scratch, though. Make sure we're all on the same level. We all have the same understanding. So even if you already know this, hopefully you'll still pick up a thing or two from the class. But with that being said, we have an hour scheduled for the class. This one, the content is a bit, I'll say, less significant in terms of the overall length of it than the prior lecture, so it might go a bit quicker. So I'm super happy to maybe spend the end of our lecture tonight doing maybe a bit of a recap of these first two lectures, and maybe even kind of a warm up into our lecture for next week. So with that being said, just a couple kind of reminders. I know a lot of you guys were here, but for those who weren't here in the last lecture, I'm going to keep it brief. Basically, the way this lecture is structured is generally very similar to what I would expect to see out of a college course. There's different ways that the content is presented as we go throughout the material. Just please don't hesitate if you guys have any comments or questions, just throw them in the chat. If I miss it, sometimes the chat moves pretty quick, so just throw it in there again. If I ever talk too quickly, just let me know, tell me to slow down, or you didn't get something. I'm happy to slow down or repeat myself. And with that being said, let's get right into it. So just one final recap of the schedule here before we fully move into everything. Last week we covered the stock options basics. Today we're moving on to Greeks. And then like I mentioned, from here on out, it's going to be a little bit more chart focused. So we're really, like I said, going to get into the meat and potatoes of things. Next week, we're going to focus on candlesticks, kind of the basics there, and get into some patterns. And then it'll only get more and more complicated after that. So hopefully after today, you'll feel like you have a decent kind of building block understanding of the basics of options, kind of how they work, what they're comprised of, when to trade them, when not to trade them. Well, maybe you won't have too much of an idea on that specific thing, but at a high level, you should have a pretty good understanding, and hopefully to the point where you could explain to somebody else what options are and how they're different from just trading shares. And if you don't feel like you already have that understanding, that could probably be a good goal for the end of this class, is just yeah, see if you can get to the point where you feel like you could understand options well enough to explain them to somebody else. All right, and just a reminder, I think it's important to remember what we're all focused on here, and especially my goal for all of you is to develop you all into successful traders who can find and execute on the highest probability trades and act on those opportunities with confidence. Now, what I want to do, I think in life in general, it's important to have goals and think about how we're going to be getting there. So whether you resonate with the same exact goal or not, definitely encourage you as you go throughout this course series and start this year out to really have some goal as it relates to how you're going to perform and how you're going to behave as it relates to the financial markets and your trading habits. But a couple steps that we're going to be taking towards this goal today is, again, just continue to build those building blocks so that you can understand the financial instruments that you're actually trading, right? There's no way you're ever going to be a successful trader if you don't understand options or don't understand the market. So this is really just the building block or the core, or the foundation of your trading knowledge for us to expand on later in the course. So, all right, last question here from Miko. If the stock is currently trading at 277, you bought in at 72 cents, the strike price is 260, you weren't able to hit anything lower than 260, do you break even? I think I understand the question, and my answer is going to be your option contracts do not need to go in the money for you to make money on them. Point blank, period. That's the end of the story, right? Just because, let's say, for example, back to our chart here, if we're looking at the S&P, we could trade, say a 600 call and make money on it, even if the price doesn't go all the way to 600. And we'll talk a little bit about why that is in a bit more detail actually today. So yeah, let's get right into it. All right. So again, kind of a continuation on from last lecture. Today we are going to be talking about the Greeks. Before I move on, how many of you have heard this term, the Greeks, before? How many of you are familiar with what these might be? Yeah. How many of you have heard this? Let me know in the chat. Cool. A couple people are familiar. All right, awesome. Cool. So this isn't a brand new to everybody. Heard it, but know nothing. Okay. Awesome. Cool. Happy to hear it. All right, let's keep it going. So there is 5 main Greeks that basically are responsible for setting the price of an options contract. There's delta, theta, gamma, vega, and rho. And additionally, there's also what are called second order or third order Greeks, which are derivatives of these. So I don't mean to scar any of you tonight, but depending on how familiar you guys are with calculus, there is levels to this for sure. These 5 main Greeks are the most significant, but the more and more that you research the Greeks, the more you will understand that this goes much deeper than just these 5. As an option trader and just kind of getting started, it's not super important for you to understand those second order Greeks, which you may end up seeing them named here and there. Vanna, Charm are 2 of the ones that come to my mind. But anyway, that's a more kind of advanced line of thinking that we won't talk about too much tonight. But anyway, long story short, 5 main Greeks: delta, theta, gamma, vega, and rho. Starting off with one of the more significant Greeks is delta. Delta basically represents how much an options price is expected to change per the price or per a $1 change in the price of the underlying. And I wanted to pull up the options chain here and just get you guys used to this interface. So this is Thinkorswim. This is the options chain for the S&P 500 ETF SPY. And here, hopefully everybody can see. If you're on mobile, it might be a bit difficult. But here we can see the 10 strikes that are nearest to the current price of the stock. So current price is 582. We can see 582 and 583. Right dead center there for us as our at the money strikes. And then a couple kind of ancillary strikes surrounding the area. So what we can do in Thinkorswim here is we can change what we're kind of this information that we're showing to just be delta, gamma, theta, and vega. So it's showing our Greeks here. And one thing that I want you guys to notice is the delta of our at the money calls here, which are calls are on the left, is about 0.5, right? This far left column is our delta, and this is our strike price here, and this is the bid and ask price of our contract. So on the far left here is our delta of this contract. It's about 0.5. If we go to the furthest out of the money contract we see here, it's 36. And if we go to the furthest in the money contract we see here, it's 0.64. And let's just add even a couple more strikes here. And once we zoom out to be a little bit more centered here, what's the trend that we notice, right? What's going on here? We start, basically our delta changes from about 0 all the way up to, 0.99 or 1. Basically, what's happening here is as contracts go further and further in the money, that delta begins to increase. So one general rule of thumb is your at the money contract is typically going to have a delta of approximately 0.5. And as you go further in the money, your delta is going to increase. And as you go further out of the money, your delta will decrease. Now, there's a couple ways to consider this. On one hand, as you go further in the money, the amount of value that your option contract will increase is much more significant per dollar move in share price, as opposed to being far out of the money. Like, for example, if we look at these 590 calls, these 590 calls will increase by 25 bucks for every $1 the SPY goes up, right? Pretty good. But if we look at these 560 calls, these calls will increase $90 for every $1 move in the SPY. So you might ask the question, well, why don't we always just buy super deep in the money calls, right? Super deep in the money calls with high delta, right? And for some people, that might be the answer. But fundamentally, there's an issue there. As we get further and further in the money, the price of our contracts gets much more expensive. And at the end of the day, The market is a game about of percentage returns and the amount of capital you put into that. And if we take a look at the ratio of the delta to the contract price here, just pull up a simple calculator. This contract price is 22.72, or I guess we should do this. Let's divide the delta by 22.72. So delta is 0.9, 0.9 divided by 22.7, we'll say. Actually, that's not what I want to do. Opposite, I'm confusing myself. 22.7 divided by 0.9. Why can I not figure this out? What is the math I'm trying to do here? Oh, yes. Basically, I don't know why I can't do simple math right now. It's been a long day. Basically, a $2,200 contract increasing about 90 bucks is not even a 10% increase in contract value, right? So if the SPY moves $1, this contract goes up by about 5%, right? Because the delta is 90 bucks, the total contract value is, let's say, about $2,000. Where if we look at the 590 call, these calls are about $1.75 or 175 bucks. And our delta here is 26. Here, if the SPY goes up $1, these contracts are up 15, 20%, right? So these contracts would be up about 4 times more than our deep in the money contracts, just based on the delta to contract price ratio. So that's kind of one thing to keep in mind is there's a balance between kind of finding the sweet spot for this. Like, for example, we could also go to our 600 calls that are expiring in 3 days and look and see, okay, the delta is $4, but the contract price is 15. So if SPY goes up $1, ooh, man, I'm up 33%, right? Or, potentially even more than that. But fundamentally, there's other issues there, which are going to become more evident once we get into learning a little bit more about the Greeks. But that is the basic idea with delta. And again, as I mentioned, the delta of in the money calls approaches 1. And one thing that I haven't covered yet, which hopefully is kind of intuitive, is call options will have positive delta and put options will have negative delta. So basically what that represents is as the stock price increases, the value of calls will increase and the value of puts will decrease. Zoom user didn't get that. Okay, let's maybe try another example here. Let me pull up a quick notepad and we'll cover it this way. So let me see if I can make it a bit more big. Let's see. Okay, go a little bit more if I can. Okay. So let's say again, the delta is 0.5. The price of call is 1.00, which is also equal to $100, right? Because remember, we have to multiply by 100 to get our total price. If the stock price increases by $1, contract price will increase by 50 because our delta is 0.5. So after that increase in stock price, total contract value will be 150. Conversely, a delta for a put might be negative 0.5. Using the same example, if stock price increases by 1, contract will decrease by 50, resulting in N value of 50. Does that help explain it a little bit differently for you there, Zoom user? Oh, the deep in the money part. Okay. Well, okay, I didn't realize you missed that part. Yeah, so the other point that I kind of mentioned, just to kind of split this up, let's say, for example, again, the delta deep in the money versus out of the money. Deep in the money may cost, let's just say, for example, $2,000. Delta is, let's just say, 0.9, right? Same scenario as above, right? If the stock price increases by $1, increase by 1, contract goes to, I'm just going to say the delta is 0.99999, so it's a little bit easier. Contract goes to 2100, right? for a net increase in contract value of 5%. Out of the money may cost 200. Delta is, let's say, similar example to before. Stock price increases by $1. Contract goes to 225 for a net increase in value of 25%. And this is modeled off of real examples. This isn't something that I'm just pulling out of a hat, right? We have got pretty close to this exact scenario here, where we get a deep in the money contract for, let's say, for example, about $2,000 for this deep in the money call, 563, with a delta of about 0.9. And we could find, a reasonable out of the money contract. This one, the 590s are reasonable for $1.75 or $175 for the purchase price with a delta of 0.26. So point being here, even though your delta increases as you go further in the money, it doesn't necessarily provide an increasing reward, I'll say. And obviously that shouldn't be the only consideration that you make when you're selecting a contract, but certainly it's something to be mindful of. Whereas a completely reasonable out of the money contract has a price that's about 90% less, a delta that's about 75% less. But if the stock moved in the same exact manner, your return ends up being about 5 times larger than it would have been. So again, I want to reiterate, you shouldn't be calculating or determining what contract you should take simply based on the amount of money you think you're going to make from it. This is mostly meant to be an example to show you kind of how delta changes and how that could impact your returns or losses, which is an important consideration to make. Adrian says, so in summary, delta doesn't help a put options contract. So just to be clear, let's say, for example, again, the delta for puts is negative. But let's say if the stock decreases by $1, because the way the options pricing equation works, it's modeled for increases in price. But if the stock price decreases by $1, the contract will increase in value, right? Because it's opposite. So since the delta is negative, we'll make money if the price drops on puts, as opposed to when the delta is positive, we make money when the price increases for calls. Hopefully is kind of intuitive there. Lewis says the delta is higher the further in the money you go, but the cost for the contracts at that strike price is significantly higher. The price gets so high that, yes, you pretty much nailed it, Lewis. Yeah, so the last point that I want to make here is that there is certainly a time and place for, I won't say deep in the money contracts because a lot of us won't ever get involved with that, but in the money contracts, there certainly is a time and place for them. Like, for example, let's say you may think for whatever reason, a given asset is going to be entering some kind of volatile period, but in the long run, you think that it will still move higher. You could opt for a contract that's a bit further in the money because although your delta is still significant, let's say, for example, the contract is 1,000 and your delta is only 75. Let's say, for example, the stock price decreased by, I don't know, $5, right? And let's just make this easy for myself, 0.5. Contract would go to 750 for a net increase in contract value. It's about 25% net decrease in contract value, right? So let's say, for example, the call goes the wrong way, right? For whatever reason, the stock price moves against us. In this specific scenario, we're down 25%. Now, let's say we buy an out of the money call and try to do the same thing. And let's just copy the exact same scenario from here. In this specific case, if the stock price decreased by $5 for out of the money, this out of the money call goes down to $75 for a net contract value decrease of about 60 to 70%, approximately. No, a little closer to 60. Rough math here. So here you can see the difference in both directions, right? On one hand, when you go out of the money, that contract will move quicker on a percentage basis, right? I guess that's kind of the two different schools of thought. As you go further out of the money, that contract will move quicker on a percentage return basis. As you go further in the money, that contract will move quicker on a pure dollar value basis. And as we always talk about, there's obviously always going to be caveats with these situations. And we're going to talk about that in a little bit. But delta isn't just a linear rate. All these options Greeks are dynamic. They're changing basically all the time. And if we looked at SPX, so we could see the overnight chain and how that was starting to move, we would be able to see these options and delta changing live, which we should see that once in a while here. It might be kind of hard if we don't get any kind of volatile move. But we can kind of check back in on this. Let's just try and remember 58.50 calls have a delta of 4.9. I'll just try and remember that. 58.50 C delta equals 0.49. And we'll see if we can come back to that later and use it as an example. Cool. Does that make sense? I know maybe that got a little bit away from the original intent of the conversation, but does that kind of check out? Do you guys understand how delta impacts the value of options? It should be hopefully a little bit more clear there. But delta is one of the most significant Greeks, if not the most, besides maybe one other. Awesome. Yeah, those are great questions and good question from you as well, Adrian. All right, let's keep going. So if it wasn't confusing enough already with just delta alone, gamma is the rate of change of delta. And bringing you guys back to maybe your physics class in high school, think of delta as the speed and gamma as the acceleration. So for example, let's say our delta is 0.2 and our gamma is 0.1. Let's say the stock price increases by $1. All of a sudden, our delta also increases. So basically, our delta is always changing as the stock price changes. Our gamma also has a rate of change that we're not going to talk about, but there's a whole bunch of convoluted parameters that determine what the price of an option should be. Gamma is one that's going to be a little bit less relevant. It's definitely something to pay attention to from time to time, but it's not something that's going to be front and center through most of your guys' contract selection process. Yeah, Gail, it's an interesting question. Should you only look for a certain delta area? There's definitely traders that would do things like that. I'll say, generally speaking, instead of looking for a certain delta area, some traders would be more focused on like a ratio of delta to contract price. Me personally, that's not something that I very commonly employ. I'm not super familiar with anybody in here who's kind of thinking about contract selection in that manner. But the answer is you could. I prefer a little bit more of I'll say less detailed guidance on contract selection, which is something that we'll talk about a little bit closer to the end of the class. Good question, though. Okay, yeah, so delta is going to be the speed of this equation, and gamma will be the acceleration. Another way to say that is gamma is essentially going to be the rate of change of delta, and delta is going to be the rate of change of the option contract price. So if you're familiar with derivatives in calculus, delta is the derivative of the option contract price. Gamma is the derivative of delta with respect to time for all those. Not sure how many of you guys are super fascinated with calculus, but anyway. All right, we're going to kind of blast by gamma there because there's not too much significance to it. And specifically, yeah, MMA made a good point. Some traders do look for some specific delta ratios when selling puts. For whatever reason they do that, it's a little bit beyond me, but yeah, definitely something that you could do. Okay, so we kind of alluded to this in the last lecture, but theta is basically the Greek that is the enemy of all options buyers, and kind of the catch, I'll say. When you trade options, you get such a massive amount of leverage compared to the stock, right? We're talking about this now. We're talking about being able to pay, $175 for the opportunity to make 25% when a stock moves a fraction of a percent, right? That's a pretty big benefit for sure, or potential benefit. But with any benefit becomes some catch, some drawbacks, right? There's never anything that's always going to be perfect, because without it, it'd be too good to be true. So with options comes an expiration date, as we talked about. Every single options contract has an expiration date. No option contract will last forever. And with that, there is this theta parameter, or theta Greek. And as we get nearer and nearer to the expiration date of our contract, the theta eats and eats away at the value of the option contract. And you can see this a little bit in this kind of graph here. And I don't know why I have to make it bigger every time I show this, but let's just make this a bit bigger here just so you can see a bit better there. What you can see here is basically a kind of parabolic type of graph here. where the further you're out from expiration, the slower the value of that contract decreases. And as you get closer and closer and closer to expiration, the amount of theta and the amount that your contract value will decay increases very significantly. And I want to talk about some real kind of world examples. Oh, and you can even see my notes. Theta, oops. Oh, wow, I have a lot of notes on this. Cool. Yeah, so theta is an options buyer's worst enemy, right? As an options buyer, theta basically makes us lose money just by holding onto options. However, if you're selling options, this is great, right? Because if you're selling an option, you want the price to go down because that's how you collect your credit. But again, we kind of deferred the option selling conversation for another lecture. So for now, I won't cover it too much. And one last point, this is exactly why same days absolutely depreciate quickly because you are hours away from expiration. Let's take a look at some of the thetas on some contracts expiring tomorrow. So this is the January 25th expiration date. Let's just simplify this a bit so we don't see as much info. Theta here is $3.35. This contract costs $3.37. So basically what this theta is saying is within the next 24 hours, this contract will be zero. No ifs, no ands, no buts, point blank period, this contract is going to zero, right? Unless it moves in the money, at which point it would have some intrinsic value and it wouldn't go fully to zero. So basically, this is saying that in the next 24-hour period, 100% of this contract's value will be gone if the stock price were to stay flat. Now let's look at something that's way far out in the money, the furthest expiration in December 2027. Same strike, right at the money. These contracts are going for about $10,000. The theta here is $5. $5 theta on a contract that's $1,000. That's like nothing, right? That's literally nothing. Keep in mind, $100 would be 1%. So what are you? You're losing 0.05% of your contract value basically every day from this theta. So theta has a massive impact on the value of an options contract. And I've done a decent amount of research to this in the past, and there's some kind of various theories. There's no real universally accepted way on how theta actually works. What I mean by that is mostly related to Gail's question where they're asking, or she's asking, do the contract value decrease every 30 minutes or 60, or do they decrease every minute? Basically, the thought is that theta decreases the options value virtually every second, right? Every time an options contract price refreshes, the impact of theta has been applied, right? And it's continuous. So it's not just applying this value, every period. It's constantly eating away at that theta. This is just a simple kind of way to reflect, hey, this is how much money is going to be gone from this contract over the next 24 hours, but it's an exponential rate, right? It's going to continue to increase. So again, as I mentioned, there's a couple of theories on how this is applied. Some people are of the theory that as the day gets closer to ending, even if the contract isn't expiring at the end of the day, there's like a bit of a kind of artificial increase in that theta. Like it decays a little bit quicker because the options market is almost pricing in the fact that it's going to decay overnight, and there's nothing you can really do about it. So there's those kind of interesting theories. I'm not going to go too far down those rabbit holes because I don't think it's super relevant. But basically, theta represents the amount that a contract will 100% certainly, with no ifs, ands, or buts, decay over the next approximately 24-hour period. So that's why you can see all these contracts that are expiring tomorrow, their value will be gone in 24 hours. And that's contingent on the stock price being flat, right? Because remember, if we expire in the money, we have intrinsic value, which doesn't rely on time till expiration, right? Intrinsic value is simply how far we are in the money. So just because there's theta on all these contracts, like for example, we can see our in the money contracts, our 578 call has a theta of 221. The current price is $660. So if the stock doesn't move and we get to expiration, this contract would still be worth about $450, which makes sense. It's about $4 in the money. Yeah, interesting question from Miko. How would you use theta as a strategy in options? And this kind of goes in with Zoom's question. Is it better to buy the next day or further date contracts? And I think I want to spend a little bit longer on this discussion because it's a very important topic. So there's a different kind of risk to reward profile between shorter term options contracts and longer term options contracts. If you are a day trader, right? For example, those of you who have traded with flips in VC, you guys know that a lot of the contracts that he's trading in there and you guys are trading in there are very short-term expiration. And hopefully the reason that you're decently getting away with that is because of the fact that you're not in those trades for very long, right? If you don't hold a contract for a long time, you don't get to really feel the impact of theta. But that's why, hopefully it's been clear to you, or if it hasn't, it will be now. Contracts that are expiring soon are not meant to be held for a long period of time. And if you are holding them for a long period of time, you should have complete acceptance of the fact that that contract very well could go to zero and likely will go to zero. So you need to size your position accordingly for that specific scenario. Now, again, the benefit of having those kind of close to expiration contracts is they're cheap, right? I could get an at the money call that's expiring tomorrow for $337 with a 50 delta, right? If I want that same 50 delta for just a couple extra days, I now have to pay almost $150 more for the same strike and the same delta, right? So, and also based on our discussion, we know that we'd actually make less money on that one from a pure delta to price ratio, right? The delta is about 10% of this contract's price, where here the delta is a little bit more than that. It's about 15% of that contract's price. So basically, if you're trading in the short term, right, there's definitely some value to these, close to expiration contracts, right? They're going to move a bit quicker from a percentage basis. However, the longer you hold, the worse it's going to get for you. And if you aren't timing things appropriately and sizing your trades appropriately, I cannot stress this enough, you will 100%, absolutely, with no doubts in my mind, blow up a significant fraction of your portfolio trading short-term expiration options. We see it all the time. People try and chase these and trade these for the same kind of reasons that I outlined, where, they're cheaper, they're going to move quicker, I'm going to make more money, blah, blah, blah. Sure, all that might be true, but the one thing that people seem to always hopefully forget, or always maybe intentionally forget, is the fact that just because you make money quicker in these, you're also going to lose money quicker, right? If they move quicker to the upside, they're going to move a whole lot quicker to the downside because you have delta and theta working against you. And if you're buying a contract that expires the same day, it's just going to sit flat and start to decay and decay and decay. Let's try and find just a nice period throughout the day where we were kind of flat. Let's take a look between this 11 a.m. and 12 p.m. period here. Let's look at a contract that was expiring today. So let me pull it up. SPY 2501. Let's see if the 14C. We'll look at the 585 calls. Oops, wrong check. 585 calls. So I'm pulling up the 585 same day calls. These expired out of the money at 0.01, worthless, right? No value to them. Let's take a look at what happened here on our same day calls. Let's say, for example, for whatever reason, I thought, 10, 11 a.m. was a good time to be bullish, right? I thought this was the time to get long for whatever reason, right? Whether that was a good idea or not is not important right now. And I'm just zooming in on the 1 minute really quick to just show you guys the impact of this. Let's say, for example, again, I decide right here at 10:50, I'll just mark the time on the chart. Actually, I'll mark it right here at the highs. So right around 10:58 a.m., I decide to get long. Okay, let's take a look at what happened, right? So this is a at the money call. This is a 585 strike. It's barely out of the money. Same day expiration. Marking the same time on the chart, 10:56. 10:56 right here. Contract price was 36 cents. About 20 minutes later, the stock price hit the exact same price, 11.20. Where was this contract at 11.20? Right around here. The stock price hit the exact same place within a period of 20 minutes. The contract is now down 15%. Stock price is flat. Again, the stock price revisits the exact same area at 11.40. 11.40 here on the contract. Oops. 11.40 here on the contract. Same price. The stock is going to the exact same price 3 times, right? Flat. The stock is absolutely flat throughout this period. Same exact price. Zero change in the stock. The option contract is down 37%. The price of the stock has gone nowhere. You're down 40%. Obviously, this was cherry picked, right? I said you bought a complete high, but fundamentally, the principle still stands, right? Even if you bought, let's say, the low of this range at 10:45 a.m., right here, 10:45 a.m. would have been your buy right here. You bought the dead bottom. In an hour, by the time we were at the highs again, $1 higher than when you bought it, and just an hour later, you're break even. Prices increased a whole dollar. You are even, and you got a perfect, beautiful entry at the bottom. This is my advertisement against same days. Now, let's compare to something with just a little more time. It doesn't need to be anything crazy. Let's pull up, let's see. I don't even know. I just upgraded to Windows 11. I don't know how to use this yet. Let's pull up, just something simple. Next Friday, 124. Next Friday calls, and run through the same scenario. It's a bit messier, but you should be able to see this is the exact same time frame. Right here is 10:55. This is our first high. This, we need 11:20. This is 11:20, and this is 11:40. We added a week and a half till expiration. All of a sudden, theta doesn't even matter. It didn't impact the price at all. We hit the same level 3 times. Contract price hit the same level 3 times. If that doesn't convince you to add just a little bit of time on some of your contracts, I don't know what will. If you learned nothing from this lecture, I hope you at least understood this specific principle better, because fundamentally, so many people are so hooked on, the potential return of 0-day options, and rightfully so, right? They can absolutely print money, but there's a reason that the majority of traders lose money. It's because of strategies like this, where you're trying to time the market perfectly, right? Everybody in here with, less than 5 years of experience, unfortunately, it doesn't matter who you are not going to be an expert at timing the market. You're just not, right? There's people who have been trading for 20, 30, 40 years, well-regarded legends of the marketplace, who cannot time the market. Nobody can really time the market unless you have inside information that will allow you to do so. And when you size or trade contracts that basically require that you will have your timing perfect every time, well, you're kind of putting yourself at a disadvantage, right? Because fundamentally, you're trying to accomplish something that's not incredibly possible. Now, can you make it happen? Can you be profitable trading these sort of options? Of course, right? I can't deny, obviously there's a time and place, 100%. But this is exactly why these types of positions aren't meant to be held all day, right? Point blank. How do you guys like that? That was a fun one for me to kind of walk through with you. If you can't tell already, I'm pretty anti same days. I stopped trading same days a long time ago. It just doesn't work with me. I personally think I like having more time to make decisions in the market. I don't like being rushed. And when you're trading same days, you need to rush. You do not have time to sit around and think and twiddle your thumbs and eat bonbons and hang out, right? You need to be locked in, very closely paying attention to what's going on when you're trading same days. And if you make mistakes, you get wrecked. You get wrecked. And you deserve it too, because that's the instrument that you're trading. Cool. Does the change in expiration change the way delta increases? 100%, Lewis. Let's talk about that. I'll show, the positives of same days, because I want to do right by you guys. And I don't want to just, say that same days are terrible just because I have a personal bias against them. I can't stress enough, right? There's so many ways to make money in the market. I could tell you guys whatever I want, but it doesn't mean it's, 100% the way that you have to do things. And just to show you, maybe how you could have absolutely printed with same days today, if you were responsible, is playing this rip off of the bottom here, right? Let's just kind of zoom out a little bit here. Let's actually go to the 5-minute on both these time frames. Let's just blow through this one kind of simple here. So let me just resize this all appropriately here. All right. So let's say, for example, we time the market perfectly. Oh, this is not the 5-minute. Okay. So let's say, for example, we time the market perfectly and we trade this kind of break of structure. Once we break above this resistance at 580, right? Entry would be, let's just say for simplicity, at 10 a.m. today, right around here, 10 a.m. 10 a.m. on this contract is about here, and 10 a.m. on this contract, let me just clean this up a bit so it's a bit more comprehensible. 10 a.m. on this contract is, wow, actually didn't move. That's crazy. Okay. And let's say for whatever reason, we absolutely top ticked. We sold the high after SPY made it to 583.6 at 11 a.m. On this contract with a week and a half till expiration, our return would have been 30%. On the same day, our return would have been 300%, right? So obviously a big difference there. No way to deny that, right? The returns on the same day were much more significant. And the reason behind that is because the delta on the same day is probably 0.5 or even 1. And the contract is $10. So yeah, if the stock rips $2 or $3, yeah, it's going to print. For me though, I feel that it's so much easier to, instead of trading these same days, put just a little bit more capital. Well, maybe that isn't the best recommendation, but that's what I would personally do, is I would add a little bit more money to a position with more time instead of going a bit smaller in the same days, with the thought that if it doesn't go my way, I'm completely fine and I have room to hold for a reasonable stop. Like a reasonable stop on this position is these lows, right? A break below these, and I know we're starting to get out of the scope of this lecture and we're really starting to extend ourselves here. So hopefully I'm not losing too many of you with this, but a reasonable stop on this position is a break below these lows. If this contract gets below these lows, it's worth, about $50 less, about, 10, 15% drop. If this contract goes below the lows, it's basically worthless. It's down 50% below the lows. And who knows how much worse it would be if it took a little longer to break down. So for me, I'm always going to be a proponent of buying more time. I hate same days. I think it's buying time is just the easiest thing to do to just automatically make yourself a little bit better of a trader, right? That's my opinion. Again, my personal thought. I can't act like people can't be successful trading short-term contracts. You certainly can. I will also be clear, it's not nearly as great of a number of people as you may think. No matter what people say in here, I can probably guarantee you that much less people are successful with 0 days than either they claim to be or they act like they are being, right? Because just because you see a post in the gains tab doesn't mean they consistently do that. Doesn't mean anything to post a single gain in there. Anybody could do that. I could go YOLO a same day tomorrow and I could end up in there and, ooh, yeah, look at me. I know how to do this. I do it all the time. It's not hard. The hard part is the consistency, which is very difficult with same days. All right. Good discussion, everybody. Yeah, Gail, I would day trade it. If this was the thesis that I was playing an intraday breakout, I'd day trade it. I would day trade a contract with time. That's just how I like to operate. Yeah, Mag. So weeklies versus monthly options. Again, it's the same idea. Weeklies are fundamentally going to be more volatile than your monthly options, right? As you add more time to expiration, the volatility of that options price decreases. And for me, that's super helpful because then I don't have to worry. It's not even a factor for me to focus on my P&L anymore, right? For you guys and those of you who are trading these 0 days and same days, you're probably very expressly concerned about how your option contract is moving, and you're less focused about how the stock is moving. But remember from our last lecture that options are a derivative of stocks. They have their prices derived from the stock. So we should really care about how the stock is moving, not how our contract is moving. And for me, I can't really focus very well on how the stock is moving if I'm dealing with a contract that's up 50%, down 50% every 10 minutes from a 50-cent move in stock. That's just me, right? And I personally think a lot of other people are wired to think in the same way. They just don't want to accept that, and they want to stick with that kind of gambling mindset and rush you get from trading 0 days and seeing yourself up. It's a cool feeling, right? You're up 50% in 10 minutes, right? That's really cool. But it's not so cool when you're down 50% in 5 minutes or give it all back in the next trade because you're trading same days. Anyway, that covers that. All right, 2 more contracts or Greeks to talk about. These ones are much less significant. Vega is the rate of change in an options price per 1% change in implied volatility. I have the question on here. What is implied volatility? Since we're running a bit low on time, I'll answer that one. Basically, implied volatility is the market's expectation for volatility forward looking. And I have these two examples here, AT&T and SMCI, right? Two really good examples of just very significantly different expectations there. AT&T, if we just look at how this thing moves, ticker is T. AT&T moves, approximately 50 cents a day. And if we look at the implied volatility on T in the options chain, we can see that generally speaking, implied volatility is around 30%-ish. SMCI was a good example a couple of months ago, not so much anymore, it's kind of slowed down. But implied volatility still here is, in the hundreds of percents. If we look at something even more volatile, like our quantum names, QUBT, in the 200s of percents. If you look at something like GameStop, 100%, AMC, 100%. If you look at something more stable, a Google, back down to 30%. So implied volatility is basically represented in the price of an option contract. So as implied volatility increases, the price of your contract is also going to increase. So kind of similar to the concept of delta, right? If you're in a contract and implied volatility increases, well, you're going to make a little bit more money. If you are buying a contract with high IV and the stock begins to consolidate and implied volatility begins to decrease, you are going to lose money, right? It'll just be like theta decay where volatility is toning down a bit. And then all of a sudden you're starting to lose money when basically nothing's going on except the stock's cooling off. And when the market had previously expected the stock to make more significant moves and all of a sudden it stops, well, then implied volatility is going to start to go down. So the Vega represents the amount that your price of your contract will change per $1 change in IV. That's not a Greek that I specifically look at too much. I'm honestly more focused on the actual implied volatility metric. So I like to check more of this. Generally speaking, I like to only purchase contracts with IV under 100%. There's a time and place for IV over 100%, but generally speaking, I like to see IV under that 35% or 30, or I can't talk, 100% IV. Yeah, so Tesla's probably a good example of a stock that has a bit higher IV, but it's still probably not as aggressive as you think. It's around the 80 to 70% mark, which for a mega cap name, it's high. If we compare to other similar names like Amazon, it's about 40%, Meta about 50. So Tesla's high for the group it's in. If we compare to another EV, Rivian, it should be lower. Yeah, so Rivian's a bit closer to 90, 70, or 80 area. But anyway, yeah, Tesla would be an example of a stock that has higher implied volatility. NVIDIA would be a good example of a stock that has higher implied volatility. Let's see, yeah, all your quantum names, those ones are basically moving, $1 a day and they're $8 stocks. Those are going to be pretty high IV names as well. Blueprint, Norman, what did I give you, 60? All right. Oh, I don't know where my taskbar went. That's weird. Oh, okay. All right. Last one is row. This one's basically the least significant Greek. This measures the change in an option price per 1% change in interest rate. This one is only really matters when the Fed hikes or cuts. This is one that you're really never going to notice the impact of. So it's not something that I would even really care to talk about too much, but it exists. So there you go. Any questions on our options Greeks? I know we covered a lot. We had some really good discussions on contract selection. I was super happy about that. That was a nice discussion. I hope you guys enjoyed that. Yeah, if you guys learned nothing from this lecture, and the only thing that you need to take away from is this one sentence, reconsider the same days. Add some more time till expiration. That's my best advice for all of you. Yeah, Norman, we'll check CLS chart before I leave. I got one for you to check too. When will I explain stop losses? It's a good question. I'll explain like calculating stop losses. I gotta go all the way back. I don't remember. I'll explain calculating stop losses. Definitely in a lecture 11. We'll definitely talk about it in 4 and 5. Yeah, so 4, 5, and 11 are going to be the lectures that we talk about it. I'm happy to hear that, Gabriel. That's awesome. Time is literally money, and time is important. Yes, in the options market, time absolutely is money. If you buy time, you will be rewarded with the ability to be patient. If you do not buy time, you will not be blessed with the ability to just kick back, relax, and wait. You won't. You got to be quick. And in the market, it's usually never good to have to be in a rush. Um, yeah, I'll say, based on a lot of the investors that I look up to, being in a rush is probably exactly what you don't want to do. But anyway, to each their own. There's plenty of ways to make money in the market. Any advice on having confidence on taking trades? You have level set and look to play off of them. You'll write down the contracts to watch them, but not execute a trade. Having a good percentage with them paying. My best advice to you, Lewis, is when I had a similar problem, one of my mentors, told me 3 words: swing the bat. Swing the bat. What you're doing is you're going to batting practice, you're going up to the plate, you're warmed up, and then you just watch all your pitches go by. You get struck out, you go back to the dugout, and then you watch the rest of the game from there. That's what you're doing, right? If you're spending all the time doing the preparation, you have no reason not to execute, right? You know whatever system that you're using is working. So the reason that you're not executing is within you, right? For whatever reason, you're, maybe scared or uncertain, or what's more common is you're worried about losing money, right? That's fair. You're worried to lose money. If you don't lose money ever in the market, that means you're not taking any risk. And if you're taking no risk in the market, that means you're not really doing anything significant, right? Which is fine, right? If you don't want to take much risk, buy some treasury bonds and call it a day. You'll take basically no risk and get a 4 or 5% return a year and move on with your life. But for you, Lewis, I would write down some kind of sticky note, put it on your monitor, save it on your phone. 3 words: swing the bat. Because that's what you got to do. You're doing all the prep. It's literally, and don't take this the wrong way, but it's your fault that you're not swinging the bat. You're doing everything right. So a couple pieces of advice that maybe help you get there: size down, right? Trade 1 contract, every trade, 1 contract. So even to the point where if it went to 0, it doesn't matter. And hopefully you're not letting it go to 0. But if it did, it's okay. Size down so you don't have to be scared. Remind yourself that you're doing all the prep. You're doing everything that you need to be doing. So you're just wasting your time by not executing. You're doing all the hard work. You're doing the work that nobody else wants to do. Most people just want to swing the bat and fire off an assault rifle at the market, right? You're already doing all the hard part. So swing the bat. I hope that helps. Mike, how do I pick stocks for the next day? Screeners are just looking at charts, favorites. It's a combination. Screeners are definitely one common way for me to kind of filter for new names. Sometimes I like to look online. I like to look and see what some other people are talking about to get some inspiration. In terms of favorite names, I have names that I usually like to scan. I love following the Mag 7 names, Amazon, Meta, Tesla, etc. Some sector specifics, some small cap names that I like as well. I just try and scan through them. So I kind of have like a master watch list that I'll click through, and then sometimes I'll get some ideas externally, from online or even other people talking about them. In terms of selecting which stocks I like and which ones I don't, that is basically 2 or 3 whole lectures. So I'm going to do my best to not get too far in depth into that, but just some highlights that I'm looking for. These days, especially when the market's pulling back, you're looking for relative strength, right? You have to look for relative strength. So what are some relative strength names right now? GEV, right? Supplying power to data centers. This whole sector is hot, right? GEV is hot. CEG, Constellation Energy, another hot name, right? Holding up green when the rest of the market is red. That's a big deal, right? And also holding this gap up on the daily, right? Very significant. Another interesting one, NBIS, right? Emerging recent IPO. This one is in the AI sector, a little bit of a base on base setup, broke out of this base, now starting to base out under this new high. decently nice looking volume patterns as well as it moves into this high. So another nice example there. In the large cap space, Google, right, holding up nicely while the rest of the market is red. If we take a look at the EMAs, this one is still in an uptrend, right? Green cloud here with the 9 above the 20. Where if we look at the S&P, we got a red cloud, right? Downtrend. If we look at the Qs, red cloud, downtrend, right? Also below the 50 simple. We look at some other comparable names, your Microsoft, not holding up nicely at all, right? Google still in a full uptrend and just kind of hanging out around these prior highs right around 120 or 192. So nothing too crazy yet, but still kind of hanging out nicely there. Another interesting one, Roblox, right? Similar idea. This is a name sitting basically, from a fundamental standpoint, this stock I think sucks, but for some reason people want to buy it. Volume increasing on the way up. We got earnings coming up in a couple of weeks for whatever reason people are interested in buying it. It's also cracking this IPO low, which was set over 3 years ago at this point. So big technical level there. So this is basically the speed run of the things that I'm looking for, especially in a market that's weak, right? This is the best time to scan for names that are strong because the leaders when the market are weak are going to be the first movers or the most significant movers once the market turns back up, right? Obviously, by every definition, the market's weak at this point, right? It's in a short-term downtrend, whether you like it or not. We're below the 50 simple moving average. EMAs are declining. We're breaking below key levels. We're setting lower highs and lower lows, right? This is a downtrend. This is our first kind of reversal attempt as of yesterday. We kind of protected yesterday's close as of the close today, so decent look tomorrow. A move over 585 would be welcomed, and that would be kind of the first sign that maybe this low is the actual bottom. And that would allow us to really start looking more seriously at entries in some of our relative strength names. So I blew through that really quicker than I could even remember what I was talking about. But basically what I look for is relative strength. I look for sectors, names that are moving together, which again, some of those names that are moving together right now is your AI powering names. So again, that's your GEV or CEG, GEV, VST, I think as well, also does power for AI data centers. And then kind of some of those supporting sectors as well. So your NBIS, Sound as well, I think is, never mind. Haven't looked at that one recently. That is not an example of relative strength. That is an example of big weakness, but still something that you could maybe explore. Oklo, that's kind of the more nuclear idea. This one's been a bit weaker, but still kind of holding up decently well compared to this kind of large rally that it undertook, and maybe just kind of starting to retest that flag there a little bit. But anyway, that's kind of the rushed summary there. I hope that helps a little. And then the cloud indicator, I don't know what it's called. I think it's just called EMA Cloud. I've shared it before. I can share it again. Let me see if I can find it. Script, no. Where is the stuff that you shared? I don't remember how to see the things that I've shared before. Well, I could probably share it again. It's this, I think. I'll send you the link in the chat there. And then, oops. That. And then if you want to import it, go into, where do you do it? Is it setup? Yeah, go to setup and then click open shared item, paste it in there, and then it should just add in there for you. And that's the EMA cloud. So it basically just does 2 EMAs. Well, it could do more than that, I think. I think it could do all types of averages. Yeah, it doesn't need to be EMAs. It could be simple averages too, but it's just a 10 and 20 EMA. Cool, guys. Well, I appreciate the time. Next lecture, I think is really where we start to kick it into high gear and hopefully start talking a little bit more in detail about everything that I just kind of covered tonight in this a little bit more ad hoc session. But okay, sure, Norman. CLS. Let's look at CLS. Yeah, I mean, it looks good. It's strong in a market that's weak. Just broke out of this little base here. Pivot to watch is going to be 100. It looks good. I mean, it looks like it wants to push these highs. Volume's really high. This looks like a heater, Norman, but this isn't a market where I'd be kind of I'm a little bit more concerned buying breakouts right now. I'm more interested in not buying breakouts and trying to get in at a bit more of a reasonable price when I can. But yeah, cool. All right, guys. Well, again, appreciate your time. And yeah, I can't wait to see you guys all in the next one. Adios, everybody. Have a great night. Thanks again.